What we're seeing is because of the increased US deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031. Now, like you said, people are going to hear that and say, oh, I don't want to wait that long. But keep in mind, that doesn't mean we're not going to make new all-time highs before that. It just means the next cycle peak, the one that, we dream about, that may just take a few years to come by. And it's really at shortest about 3 years out.
Unchecked global debt expansion, escalating fiscal deficits, and persistent fiat inflation are fundamentally altering precious metals markets. These macroeconomic pressures are shortening market cycles and preparing gold for an extraordinary structural bull run. Gareth Soloway, a master chartist and chief market strategist, outlines how compounding central bank liabilities will trigger this historic monetary shift. Utilizing a proprietary cycle model that tracks global M2 growth and currency erosion, he projects gold reaching a staggering peak prediction of $13,000 per ounce between 2029 and 2031, while new high watermarks could emerge sooner. Ideal long-term accumulation sits around $3,500 to $3,700, with a daily closing price above $4,100 signaling an immediate technical breakout. In our analysis, as central banks remain trapped by high debt servicing costs, holding physical bullion remains the single most reliable hedge against systemic currency debasement. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
It's based on a calculator that I created, and essentially the calculator takes into effect multiple factors. One is how fast is the money supply? And again, we're not talking US money supply, global money supply running. And right now it's running at 7%. So if you just assume over the next 5 years at 7.5% or greater, that starts to push the cycle of gold. And what we looked at here is when you have the first cycle between 1980, the second peak was 2011. So we're talking, 31 years there of interim cycle. And then the next cycle, it was just 2011 to this 2026 high. And so what we're seeing is because of the increased US deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031. Now, like you said, people are going to hear that and say, oh, I don't want to wait that long. But keep in mind, that doesn't mean we're not going to make new all-time highs before that. It just means the next cycle peak, the one that, we dream about, that may just take a few years to come by. And it's really at shortest about 3 years out. The calculator accounts for all of those cycles, right? Or all of those factors, and it gives different weightings to the importance of it. Part of the cycle calculator as well is analyzing the fiat feeling. And then what I mean by that is, how do people look at fiat? And if you looked at in 1980, we had incredible inflation, but at the same time, we saw Volcker come out and he really reestablished that we're going to clamp down on this. And over the course of that next 20, 30, 40 years, we've seen the fiat feeling. In other words, how do people feel about the dollar and other currencies? And we know they're printing them and the governments are running up debt. It's starting to slide. And so these factors all go into the model, and it really just projects out based on the past cycles and how quickly it's coming. When will the next cycle be, and what is the likely peak, taking into account these other variables? I think it's more about the structural need for people to have security, and it's the fact that the dollar needs to be measured. And this is interesting, right? If you look at the dollar, the DXY, we're basically at levels we were years ago. And so if you look at the dollar by itself, you say, well, the dollar really hasn't lost any value. That's not true. And the reason it's not true is because you're pricing it against all the other currencies, the 5 other currencies, and they're all printing too. And so really it's a matter of saying, okay, well, yes, the dollar is still holding its strength, but that's relative to these other currencies that have been printed ad nauseum with the dollar. You have to look at it on a universal basis against the growth in supply. I believe gold is growing about 1.7% per year in supply versus the printing of money, the debt increase, all of these other factors. And that's one of the reasons why this model shows that there is such significant upside in gold, because there's no chance, in my opinion, there's no chance we can go back to Volcker, right? Yeah. I mean, could you imagine with the US debt where it is, if interest rates even went up to 10%? And so when you have that in effect, it means that Volcker can't come back, which means you're not going to get a downside move like we saw in the 1980s in gold. And in other words, it's going to drive gold higher quite substantially. If we saw, let's say, AI create deflation, right, if we saw the productivity going up substantially, but again, that deflation being created by AI, that would be something that we'd have to take into account. And what's interesting is with the model, it actually gives us a significant ability here to kind of project that out. And I want to, if you don't mind, I want to try sharing this with you guys. If we get to this, and here's the gold calculator, what we can see here is that we have our different inputs. You have debt issuance pace, and this is right here our current conditions. So right now, every year the U.S. is printing basically $2 trillion. All right, and the idea is that that's probably going to go up based on the kind of the cycle that we've seen with it increasing over time. Then we have global money supply rising at 7% a year. We have the fiat mistrust index, which continues to inch up little by little. And then we have real interest rates. And so the idea is that what I did is I said, okay, this is my base case. And if we flip to the base case, it shows that on average over the next 5 years, we're likely going to be printing or adding additional debt per year of 2.8 trillion. And that's the average over the next 5 years. Global money supply is going to likely increase to 9%. The fiat mistrust analysis is going to accelerate. And then real interest rates is going to be drifting to zero. In other words, the Fed is likely going to eventually cut rates, but inflation is not going to go down substantially. And so when you calculate that all out, it gives us a target range right here with a $13,000 peak. And again, what's beautiful about this is you just brought up, like, what if real interest rates are positive? Well, now all of a sudden, this changes the calculation to $6,000. And so people can really, and again, I can give you guys the link so people can actually just play around with this. You can put in your own numbers. Like maybe you think the debt issuance pace will jump massively to 4.7 trillion. In any case, the point is the calculations tell me, based on my best assessment of the data and probability, that we're looking at that next peak around 13,000. The level where I will start accumulating more gold is at around 35 to 3,700. So we're almost there. We get one more little flush down, I would accumulate more long term. Now, on a swing trade basis, when we look at the chart is always my guide on a swing trade basis. So looking at the chart, as soon as we take out this high pivot here, go to the charts here, this right here, once we get above this, that's where I would buy as a swing trade basis. But again, for my long-term holdings, I just buy physical and I wait until I get it to a level where I feel comfortable. You know, I never want to sell my physical. If my physical silver and gold is my insurance policy, where if I don't need it, if catastrophe doesn't happen, I pass it on to my kids. It's just that that's the way I view my long-term physical holdings. If I want to buy and sell, I'm doing it on a swing trade basis with the GLD or other metrics or other ETFs.
Silver currently demonstrates distinct technical weakness due to softening industrial demand and potential slowdowns in tech sector data center capital expenditure. The charts reflect heavy overhead resistance following a key breakdown, making a retest of $50 per ounce highly probable, with potential downside extending into the $40 to $45 region. A sustained trend reversal requires reclaiming the $64 to $65 resistance zone. Conversely, quantitative modeling shows that even under positive real interest rates, gold maintains a conservative $6,000 base target. From a risk management perspective, silver's dual industrial identity makes it volatile during economic slowdowns, whereas gold acts as a pure monetary anchor against fiat inflation. Investors seeking capital preservation should prioritize physical gold over speculative paper metals during macro consolidations. Now, let's get back to the interview.
I think for the most part, it's exaggerating it just because silver tends to move in multiples of gold, or at least 2x gold. I am not loving this chart yet on silver. I still think there's downside. You can see, again, you had this beautiful base right here where we just kept on hammering on it as support, and then finally we broke lower. And then notice how this trend line was support, but once you break down, it becomes resistance. And we went up into it and price got rejected, and now we're just kind of floating sideways. There's no no real good nature to this. So on silver, I need to see us recapture this $65 to $64 level and break out above this trend line, much like I need to see gold break out before I can get heavily bullish on this. And I actually still think there's a good chance we touch $50 and retrace to the 2011 peak before silver really has its next major run. I wouldn't be surprised if silver still has more downside. Now, you might say, well, can gold break out without silver? And the answer is it can. It's generally unlikely, but it could break out slightly. And the key why silver could be an underperformer is imagine all of a sudden we get a slowdown in CapEx for data centers. We know that a lot of silver and copper is being used there. Or if the global or domestic economy slows down, that industrial side of silver could mean that silver does underperform in the near term if we get that economic slowdown. I would choose gold for the longer term. And I say that mainly just because it's safer, right? If you're thinking about someone who has a longer term horizon that doesn't want to be scared out of a trade. I mean, for all we know, silver could come back to $45 or $40 per ounce. I think the gold trade is the one because it's the one that's most directly tied to what we know, which is the U.S. debt is at 40 trillion almost. We have that kind of the printing of the global fiat continuing to rise at least 7% a year. And so you're playing directly the play that the governments and central banks are going to never really be able to rein that in because global debt is just so high, right? So we just can't go back to that Volcker style, which means long story short, you get more money printing. So I think gold's the safe kind of play. Is it going to be the sexiest? Is it going to go the most? It may not, but at least you sleep better at night. So the Fed right now, their statement and Jerome Powell's commentary, it is giving the markets a very good rally off the lows. Earlier today, we saw the semiconductors getting slammed again. SanDisk fell all the way below $1,000 before reversing to 1,100 here, and we'll see where it ends for the day. But the point is here is that the markets liked what Jerome Powell said. He left the door open to not just using interest rates to kind of tighten monetary policy, and I thought that was a very good thing. I also think it's good that he's taking it seriously. He's showing he's not a pushover, which gives the market a little bit more confidence in the Federal Reserve. And it is, again, driving gold up, silver up, and the stock market here in the afternoon session. And I think that's part of it. I think Kevin Warsh, there was this a little bit of concern. In fact, going into today's announcement was the highest probability that we have seen in a long time that the Fed might actually hike rates on the day of the meeting. I think it was around 38% this morning, the odds that they would hike. And so the market's breathing a sigh of relief. They also, like I said, loved the aspect where he said there's other manners in which the Fed can attack inflation besides raising rates. And again, the market's still pricing in a September rate hike, I think about a 60% chance, but it was up north of 70%. And so again, all of these things, we're seeing the US dollar fall to the downside, gold starting to take off, and obviously the stock market likes this statement. Yeah. And that's really what the charts are telling us. So I mean, great move on gold, but look at how this what we call a wedge pattern in technical analysis has behaved. You take your all-time high, it hits again here and here all the way down. And recently, we've been hugging just below this major trend line. And this trend line for me is essentially the line that I'm watching to know when there's a breakout in gold. And notice how today we rallied up into that line, and so far gold has pulled back off of it. And so as a technician, simply put, just like you said, 4,100, we need to clear that hurdle on a daily closing basis. If that happens, you have a short-term breakout. I don't, by the way, think gold's going to zoom right to 5,600 again. It's going to take some time. It's going to take some digestion, but that's the first step in potentially seeing gold start to recover and move back to its all-time high. I think, again, we have to respect the trend line that has held up since the highs on gold until price really clears that hurdle and holds above it. I'm looking at it a little skeptical. Now, you guys know that overall I've been bearish on gold, but I'm now at a point, and once we got below 4,000, where there's a little bit of downside potential, but we're close to the end of this down cycle before I do think the price on gold starts to move up. And it's got some upside potential over the next few years.
Recent Federal Reserve policy updates have sparked a notable relief rally across global risk assets and precious metals. Central bank officials hinted at utilizing non-rate policy mechanisms to combat inflation, reassuring investors and dampening fears of aggressive interest rate hikes. This dovish pivot weighed heavily on the US dollar while boosting market confidence. Technically, Gold is testing a critical descending wedge pattern that has dictated price action since its record high. A decisive daily close above $4,100 will break this technical resistance and initiate a fresh macro recovery phase. Quantitative models indicate that with national debt topping $40 trillion and global M2 expanding at 7 to 9% annually, underlying fundamentals strongly favor tangible assets. Our view remains clear: central banks cannot return to aggressive tightening without risking broader debt crises, while short-term chop and consolidation will continue. Current chart formations represent a classic accumulation phase ahead of gold's long-term advance toward $13,000. Investors should focus on high-probability technical setups rather than reacting to short-term headlines. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.